Welcome to the Daily Update. This is being prepared Friday, July 15th, where we'll look at the action in the market today and then see how things look for Monday, July 18th. We had a really powerful day on Friday. Some of the things that we're seeing under the surface, they kind of took a little bit of a back seat as far as improving the sector rotation. And I'll show you some charts to go through that. But we ended up having a really strong day after all. So let's go back. First of all, just please be reminded that I do have a temporary email address, spxinvesting@gmail.com, and there will be no video on Wednesday, July 20th. So now let's go back and talk about what happened. We did have a gap higher right at the open. There were some economic reports that came out that the market took as positive. And the futures had been positive even before the release of the retail sales report. But even after that, the market just decided it wanted to go higher on Friday and was going to use anything to justify that. So we were above R1 at 38.17, and we also went above R2 at 38.44. As the day went on, prices pretty much just drifted sideways. We went up, and then it looked like a smokestack. You'll see that when I get to that chart. And so we just ended up going sideways at the highs. And then anytime we came down, R2 then acted as support. Going into the close, prices closed at the high. So that's pretty positive too. But one day does not a trend make. So we'll have to see how things end up changing. We were up 1.92%. We were not necessarily oversold at this time. None of our indicators were really suggesting that. So the fact that we bounced up, it was not wearing off an oversold condition. So we'll have to see, is this the start of something? We had a pretty positive looking bar on Thursday that I'll point out. And then we had a 1.92% climb on Friday. Is that going to change the environment? Volume was below average. And then our fixation, the technicals, they had pretty much all gone negative. And that's one indicator in and of itself. When we have pretty much across the board, all time frames, all of our indicators for the most part are giving us negative signals, that can mean that we're due for some kind of a move in the opposite direction, just to wear off some of those signals. But the big deal right now is inflation and interest rates and growth concerns. And then, of course, geopolitical concerns with Russia, Ukraine at the head of that list. You also have the president out of the country right now. That usually isn't a really big deal unless something strange happens. And then earnings. We're starting to get into earnings season. And there were some positive earnings that came out on Friday. And that helped to support the idea that prices could move higher. But the big debate continues to be the recession fears. So what are some comments that we can make? Our sector rotation is holding up. It didn't really shoot up. What we're seeing is on the down days, that's when the smart money looks to be getting into more growth type of investments, switching from value back into growth. On the big up days, well, the growth sectors don't really seem to do as much on those days. They didn't decline, but we were pretty much flat. We still have two major yield curves. Well, one major, one minor. The 10 to the 5 is not really all that major as far as trying to gauge if we're going to go into a recession. But the 10 to the 2, that's big. And that's what a lot of people use. And they're still inverted. Fear is decreasing slightly. We're coming slightly out of the extreme fear category. And the economic reports, as I stated, were taken as positive. And they're really concerned about hike fears. Are they going to raise them 0.75% at the next meeting or a full percent? And that kind of goes back and forth now. We did have retail sales coming out, and they increased 1% month over month. Now, that was stronger than expected. But since retail is a huge part of the U.S. economy, this was taken as positive because they're really worried that people can't go out and buy things with so much inflation going on. Well, when this came in pretty strong, the market really liked that. We also had industrial production. It decreased 0.2%. They expected it to be up 0.2%. So that's a little weaker than expected. And then capacity utilization, it decreased to 80. Well, they expected it to be at 80. So that was kind of already baked in to the market. Consumer sentiment actually ticked up a little bit. It had gotten all the way down to 50. They expected it to be at 49.4. It came in at 51.1, so higher than they thought. And our trend is, it's a negative trend. We've moved back up above the line, the 20 mark there on the ADX. Our bias, I'm still saying, is mixed because we just had one up day. We're not really seeing anything that could lead us more to being more positive right now. And our momentum is also mixed. So let's go back and look at sentiment. We just ticked out of the extreme fear category right now. So we're in the right on the edge of the fear category. And here just shows how we've been camped out along this level for a lot of the spring and summer while we're kind of peeking our head back out right now. Here's some Isabel Net charts. This is the updated Fed balance sheet projections, where this dark line, this is what's actually happening. This is the Fed balance sheet. And in the weekly video, I usually bring up the Fed balance sheet. It typically updates once a week. Then this kind of golden orangish line, this was what they projected quantitative tapering, QT, to be. They thought it was going to be more than what now they're projecting, that it might be more shallow. They're not going to get rid of things as quickly as they had been saying before. This next chart, which just looks like lightning all over the place, the one that we focus on is the red line here. And this is bear market post-mortem. This is how bad do things get. And here are some other times with dates marked on here, just showing how long this lasted and how deep we ended up going. And we're kind of in about the middle right now, both on time, and even though it could end at any time, and we're also in about the middle as far as how far we've fallen from the all-time high. This is showing the economic output composite index, and it's really dropping off. We have the LEI, the leading economic indicator. That's the light blue line, and it has been declining. And then we have the LEI, the 6-month change, again on the blue. And then we have the economic output composite index. They're both declining together right now. So this is suggesting that we're seeing a slowdown in the economy. Here's oil inflation be against the headline inflation. That's the CPI. That's the inflation rate that we hear about. And right now, where we have crude has really been falling down, which is really helping folks. And this gray line here is just a projection. The Refinitiv here, whoever made these charts, they're projecting that oil prices are going to continue to decline. And then the blue line is the headline CPI. This is what we had over the past week, where it's really been going up. So we're seeing a real difference between them, where a lot of times these tend to move together. So what's going to happen? Is oil going to come back up to justify the CPI, or is the CPI going to start coming down? We don't know, or a combination of the two. This is kind of a crazy looking chart. This is from Nomura. That's a Japanese investment firm. And these little red boxes here, these are the expectations for the Fed policy rate path. And the lighter red, this is what they had been projecting. This is their forecast. And they were expecting it to be a little lower. Well, now they're with the dark red, they're expecting it to be a little bit higher. And this just shows how things are going up over here with the percent. And then they're eventually going to top out at between 3.5 to maybe 4%, according to this forecast, before they start coming down. Again, this is just a forecast, and these can be changed at any time. We also had the active asset manager survey come out, and it declined a little in the last reading as we were having some difficulties in the market and significant down day after down day. Then we also had an update with the real GDP nowcast. This is put out by the St. Louis Fed. They're still showing positive GDP for the second quarter. Then we look at the Atlanta version of the GDP now, and they're showing a decline. So that's kind of what it's been over the last week or two. Here's the consumer sentiment, where it had gotten way down to a reading they've never had before in this survey before bouncing back up a little bit. So people are just a little more optimistic right now, according to this. Now, this is the preliminary reading, and we'll get the final reading at the end of this coming week. Is it, or is it 2 weeks? But after that will be the final reading. But there's still a really high spread between the 2-year yield and how people are feeling right now. Here's the Ridex bear bull ratio, the most updated version I could find, where we're at 0.13. So they're kind of in the middle between bearish stances and bullish stances. Here's the VIX showing that because of the up day, we really declined on a closing basis and the bar really dropped as well. The VIX of the VIX also is showing a decline. And that's what we see. When the market's going up, we see the VIX and the VIX of the VIX tend to decline unless something strange is going on. Here's the ulcer index. It's also measuring fear at being very low according to this chart. As I've been saying, though, check out the weekly version of this chart. It's much higher and probably a little more realistic to what we're going through right now. We're down 19.83% from the all-time high. So we're slightly out of bear market territory now. The equity put call ratio on a daily chart did decline, but we're still going up on the 5-period chart. Now, this is another thing that I've been showing. This was a week ago. At the July 27th meeting, there's a 92.4% chance that we're going to raise it 3/4 of a point or 75 basis points. That was a week ago, Friday, July 8th. All right. Now, this is what it was on Thursday, July 14th, yesterday. We're about at 50-50. After we had the economic reports come out on Friday, this is where we're at right now. There's almost a 70% chance that we are going back to the 0.75% stance. And so this is going to change pretty much every day up until the meeting happens. So this is when we start to follow this. So I'll start to update these charts. We also have the national financial condition. It is going up, but we're still below the black line. And here's the spread between the risky options or risky loans and the not so risky loans. And it's actually continuing to come down slightly. Our support and resistance, here are the pivot points for Monday's session. Here's the daily chart showing how we got all the way back up to the pivot, and that acted as overhead resistance. And down here at the bottom, you can see where we were below average with our volume. This is the machine gun chart looking at the possible support and resistance areas. This is a little bit cleaner where we're kind of above this longer term support now. We've got a lot of different levels that we could bump into currently. Here's the daily chart for July showing how we've come right up to the pivot for right now. Here's the Fibonacci retracement, how we came back down, and now we're starting to come back above these 2 Fibonacci levels that we've been watching closely, and we seem to have been around for a long time now. Here's the weekly chart where we're back above the 38.2% retracement. Different sectors. The sectors that did the best on Friday were the financial and communication, as well as healthcare. They were up over 2%, with financial being up over 3%. And there was no sectors that were down. We saw pretty much across the board strength in Friday's session. Here is the scooter score, just rating the technical analysis of the utilities, healthcare, consumer staples, and energy. They're all in the 90 category. Then I usually focus on the ones that are in the teens, where we have materials and communication are all below 20. This is the chart that we've been seeing pretty much every day in 2022, with the energy sector doing the best, utilities slightly positive, and the rest of the sectors down since the all-time high. Here are the different indexes since the S&P's all-time high, showing the Dow has been holding up the best, with the NASDAQ 100 and the NASDAQ doing the worst. We had pretty much all positive. In fact, we did have all positive technical alerts. The S&P got above 3,800. We dropped below on the BPI chart. We dropped below 30 yesterday. Well, we came back above that today. And the other signals relate to other indexes. Here's the intraday chart, where we gapped higher, and it looked like we wanted to go higher anyway, even before this report came out. This just kind of justified what the markets wanted to do. But here we got above R1 and eventually made it up to above R2. Once we got above R2, we kind of exhausted. This is the smokestack look that we're seeing here. It's just kind of like blowing off in the wind. And then we had a nice little buy program come in right at the close, which pushed us to the highs of the day. So our trend is dropping down slightly below 20 right now. It's at 19.94, but the red line is on top, so we have a negative bias. This is the Arun chart. I haven't shown this in a while because it's just been flatlining for a long time. It's showing that there's a decrease in selling, and we're kind of flattening out after decreasing with the buying. So the oscillator is showing a little bit of improvement, but we're still below zero. Brett saw a really nice advance based on price up near this blue line, which means extreme. And we saw a nice advance based on volume. So our overall charts did show some improvement. We're still negative with the advance decline ratio because we're below zero, but it did bounce up. New highs, new lows. We saw a little tick up in new highs, and this is starting to turn up, but we're still negative overall. Our accumulation distribution, it is hanging in there and actually showing much more improvement now. Some of the short-term charts, we might have exhausted ourselves in one day because we have the advanced decline ratio, and it went pretty extreme positive just in a one-day move. We're coming back up through the 20-period moving average right now, both the simple and the exponential. We're coming back above this, but we still have a lot of moving averages ahead or above where we're at right now. This is really strange. The Stochh RSI, I know some people really like this indicator. It's too touchy for me, but I still show it anyway. We were extreme positive, then we had a down day, so we went extreme negative. And then after Friday's move, we were extreme positive again. Williams percent R, it's a little more tame, but it is showing some improvement. The force index also went back positive. Swinland trading oscillator has turned back up based on price and volume. McClellan oscillator has just inched itself above zero, so that's positive. We saw an improvement with the 20, 50, and 200-day moving averages. Stochastic has turned back up in the short term. It's trying to turn back up in the intermediate term. It's crossing negative in the longer term. Then looking at some intermediate charts where we are just right about at this moving average that's anchored back to the low set back in March of 2020. The PMO is still looking okay, but we're seeing some improvement based on price and volume with the PMO signals down below. PMOs that are rising, now looking back to positive, the buy signals turned up, and we're pretty much flat with those PMOs above zero. Chaikin oscillator also showing some improvement. It turned up yesterday, and it showed some follow through in today's session. Chaikin money flow is also showing us some improvement here and giving us kind of a significant reading, a positive reading. We're seeing a little bit more of a turn up in volume, but we're still well below average. The vortex has crossed over. It crossed over yesterday. The green line turned a little bit up, but it's still negative. The summation index is pretty much flat based on price, but turning up based on volume. And we're almost ready to see a mixed bag with our oscillators. The slope is still trying to cross over. The MACD showed some improvement. The KST and tricks are still positive. And the PMO, it's flattening out a little bit where the TSI, it was almost ready to cross negative, but it's showing a little bit of improvement now. Here's the BPI where we crossed below 30 and then bounced back above it in today's session. Ease of movement is still showing some weakness. The ultimate oscillator is turning back up. The TTM squeeze, from what I understand, the pale lines here, that's more positive. When they turn dark, that's more negative. Well, with the declines that we've been seeing, it turned more dark, but with Friday's advance, it turned back to more pale, and we're above this green area. So this is generating a more positive signal. Our different charts, we're seeing an improvement with the Heiken Ashi. It has an open candle. We're still negative, but could easily turn with the Kegi chart if we see any more follow through to the upside. The Renko chart is still looking fairly kind of positive right now. No change in the 3-line break. We haven't moved enough for this to redraw yet. The Elder, based on the SPX, it has switched back to positive now, as with the SPY. And we're still negative with the SAR. We didn't move enough to reverse that signal, at least yet. The highs and lows in the S&P, we're getting back more to a neutral reading after we almost, well, we did go extreme negative, but not really extreme here. We're back to a neutral purple as far as the go, no-go system. So neutral with a negative bias. Longer term, we're seeing an improvement with the 50, 150, and 200. They all turned up. The special K is flatlining to trying to go a little bit higher. And here's the weekly chart that I showed earlier, where we're above this 38.2% retracement. And the diamonds have switched back to positive. And I'll show the Qs here. But with the Dow, we're just getting above the pivot level. And here, the Qs have switched back to positive. And the NASDAQ 100, it's staying above this pivot level. Now, can it get into this moving average? That might act as resistance. With the up day, we did see the Vixen really decline, both with the bar and on a closing basis. Here's the NASDAQ staying above this pivot level, possibly dealing with the moving average. Here's the Wilshire. I wanted to bring that up because we got back up to the pivot level, which may be acting as overhead resistance. Can we break through that? That's a broad market measure. The dollar declined almost 0.5%, but we're still in a really strong uptrend overall. And the dollar was negative even before the market opened. So that kind of gave a boost to the futures, which then gave a boost to the market, the stock market, when it actually opened. And we're pretty much neutral comparing the S&P movement to the dollar movement. Oil, it was up 1.89%. We're still under 100, but it did bounce up. And here's the correlation where you have the S&P and oil kind of going in the same direction now. Not really heavily, but a little bit that way. Gold recovered. No, the ETF was down. It was silver. Yeah, silver actually bounced up over 1%, but still very, very negative on a trend basis. Here's the bonds. They were up slightly, but we're possibly building a base down here. We're trying to match the COVID low that we set with bond prices. Here's the correlation between the S&P and the 10-year, where they're tending to go more in the same direction. Here's the tech sector to the 10-year yield. They're also starting to go in the same direction. So it's not really helping us all that much. It's when they're going in the opposite direction. That's when it seems to be a little bit stronger. We still have two yield curves inverted. The 10 to the 5 is negative, and the 10 to the 2, which again, this is the one that most people watch, and it actually dropped down even more after today's session. We're keeping an eye on this. This is the 10 to the 3 month, and it continues to drop down. If that goes negative, again, a lot of folks that are holding out saying, we're not going into a recession. Look at the 10 to the 3 month. They're going to change their tune if this yield curve does go inverted. Here's the 30-year, where we're still around 3.10%. Here's the yields across the board, showing that we're declining a bit. And here's the intermarket analysis chart, showing how oil, my goodness, it was up over 65%. Now it's up only into the 30%, 33% right now, with number 2 being the dollar. Gold has gone negative, as have stocks and bonds. Our scenarios, still looking okay with this scenario, looking at the 5-period moving average of the highs and lows going across the huge spectrum of the market, where we gave a negative signal or extreme negative signal, and we're bouncing back up. And Friday's action helped that. Here's the 10-day moving average just within the S&P. After giving an extreme negative reading, we bounced up, came back down. Now we're starting to bounce up slightly again. Here's those stocks above their 200-day moving average. That really hasn't moved that much yet after giving us an extreme reading. And then on a shorter term basis, those that are above their 50-period moving average, this is still holding up with the mid caps and the small caps. So those we're seeing some continued confirmation across different indexes. And then with the VIX, this is a 5-period moving average and a longer term chart after spiking up and coming back down. With Friday's move down, this helped the moving average to decline. The Copic curve, we're getting to the point where we might lose that signal, but the Pring bottom fisher is still generating a signal and still moving up. And that is directional. And here's where we were pretty much flat with the Qs to the SPY ratio and the discretionary to the SPY and large cap growth against large cap value. We were pretty much flat on this, but we're still positive overall. We're above the moving average, and we're seeing pretty much the same thing with the growth value ratios with the large, mid, and small caps. They came up a little bit. The one that I watch the most are the large caps, because those are the big companies. Those are the ones that are in the S&P 500. So I watch the other ones just for confirmation, but the large cap is what we really like to focus on. The spike, we don't really know. It looks like we could have spiked up here and are coming back down, but now it's coming back up a little bit more. And here's the S&P correlation to the 2-year, pretty much neutral right now. Staples, we're getting ready to possibly see a death cross here. And now it looks like we're coming in and we may have put in a new spike here. We dropped back down in today's session, but is this going to be a valid spike, or are we going to turn around if we have more weakness and see this spike really go back up? So what's our outlook then for Monday? The technicals, they're negative, but they're trying to improve after the update that we saw. Sentiment is not as fearful as it was, so we're just fear, not extreme fear. We have the NAHB housing market index coming out on Monday, not a big market mover. All the different geopolitical events. And I added one in yesterday's video about Italy because they're having some issues with their prime minister who resigned. And then they said, no, we're not going to let you resign. And that's putting some possible pressure on the European central banks if they can't raise interest rates because of political instability happening in Italy. That means inflation could continue to go. At least that's what the market's seeing. And then the recession. Are we going to be in a recession? Are we in one now? That's the big debate. And then these hiking fears. And you can see how they're dancing around with the Fed watch tool that I use. And this is going to be changing up until they meet. So our scenarios, we're not really down right now because of all the reasons. But if we continue to go down and we turn into a trend, these are some of the things that could impact that. The technicals are negative, but they are trying to show some improvement, possibly. We're not really up right now either, but the technicals are pretty negative, but they could be showing some improvement. Our scenarios seem to be hanging in there for right now. We're not really getting much from the technicals. And yes, we are sideways right now. That may not last for very long unless we really start chopping. But the ADX is below 20, and with the red line on top, we default to the negative for that. So our conclusion then is we're pretty much still negative across the board. We haven't really changed all that much. We don't really see that much just with one day move. So thank you. Have a very good weekend. And I will prepare the weekly video and the intermarket analysis video over the weekend. And I'll get those posted just as soon as possible.